What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. This is the podcast where we try to take boring tax topics and make them a little less boring. My name's Ryan Pulis. The podcast is brought to you by our firm, the Pulis Group. Today, we're going to talk about something a lot of investors and small business owners deal with: partner and shareholder loans, or we might just call them together as owner loans. What are they? How do they impact your taxes? What are common mistakes that you should try to avoid? So let's dive in and take a look at owner loans. So what are these loans? Partner, shareholder, owner loans, whatever you want to call them. So let's start with the basics. A partner loan is when a partner in a partnership lends money to the partnership, or perhaps the partnership loans money to the partner. And a shareholder loan, same idea, just swap out partner for shareholder and partnership for corporation. Now, this could be an S corporation or a C corporation. These types of loans happen all the time. Maybe you need to inject cash into your real estate partnership to help purchase a property or cover expenses. Maybe you take money out for a personal need and promise to repay the company later. Sounds simple enough. But if you don't treat these transactions the right way, the IRS might decide that the loan is actually a capital or equity injection. Or worse, it could be treated as income in some cases. Now, from the tax implication side, why this matters. So the big and key issue here is intent, and documentation is how you're going to prove intent. So if you loan money to your business, partnership, corporation, the IRS expects that to be a real loan. So that means there's a written promissory note, a stated rate of interest, some type of repayment schedule, and ideally those repayments are actually happening. Now, technically, there's 13 factors the IRS will consider. They're called the mix-in factors. The name comes from a court case, but these are the big ones. Promissory note, the intent, making sure there's an interest rate and some repayments are actually happening. Now, if these things are missing, no repayment schedule, no payments are actually happening, there's no stated rate of interest, there's no written promissory note, then the IRS is likely going to say this wasn't a loan, it was a capital contribution. Or worse, if the business loans money to the partner or to a shareholder and it's not documented, they might call it a disguised distribution or a constructive dividend in the case of a C corporation. If you're a C corporation, that dividend becomes taxable. And if for an S corporation owner or a partner in a partnership, those distributions could potentially be taxable. If the loan is never repaid, in the case where the business is loaning to the owner, if it's never repaid, that may be treated as cancellation of debt income. So the loan's forgiven, that's income to the owner. So here's an example scenario of what may happen. So let's say you loan your S corporation $50,000. Later, the company pays you back. There's no loan agreement or interest, never any written documentation. The IRS could say that that money you got back was a distribution. The initial contribution, or the initial loan to the business, was a contribution. Taking it back out was a distribution. If your S corporation doesn't have sufficient basis to support that, that could be taxable to you. So that same would apply to a partnership. When you have a distribution in excess of basis, that is taxable as capital gains. So ouch, that could hurt. Now, some best practices when it comes to like your bookkeeping and record keeping, you want to keep things clean, because if it's not clear to the IRS that this is a loan, they're going to assume the worst. So the first step is make sure you have your documentation in place. Draft a loan agreement, even if it's between you and your own company. You're the only owner, a single shareholder as a corporation. On the loan agreement, include the loan amount, the interest rate. Make sure you're using at least the IRS minimum. They have something called the IRS AFR, applicable federal rate. It's updated each month. You can find it online. Make sure you include a payment schedule and make sure it's signed. You can sign on behalf of the company as the managing member or the president or whatever your title may be, and you would sign for yourself. Record the loan properly on your books. So in QuickBooks or whatever accounting software we're using, loaned money to the company, owner giving money to the company, should be recorded in a liability account, something like loans from shareholders, loans from partners. If you are borrowing money from the business, it goes into an asset account. A loan to shareholder, be an asset to the business. Make sure you're tracking your repayments. So record the repayments of the loan as a reduction in the loan balance. Make sure interest is broken out separately. Interest belongs on the P&L. Taxable to the lender as interest income, deductible to the borrower if it's set up and done right. And make sure you're reconciling the account at least annually. At the end of the year, that loan balance should tie. So the loan balance on your books needs to match what's reported on the returns and the K-1s. Now, if you're dealing with a partnership or S corporation, tracking your basis is crucial too. Loans can affect your ability to deduct losses. Some best practices and tips. So a few rules just to keep in mind. Avoid loans with no documentation. Charge at least the minimum IRS interest rate, that AFR. If you don't, the IRS will impute interest and then you're going to have phantom income to deal with. Don't let loans sit unpaid for years. And if the repayment doesn't look like a loan, the IRS is bound to recharacterize it. And make sure your books and records are separate. Your personal and business are separate. So commingling funds makes it way harder to defend that something was a loan. You really need to keep separate books and records, whether you have owner loans or not. And one more tip for real estate investors: if you loan money to your partnership for a deal, that increases your debt basis. This can help you to deduct more in losses. So loans can actually be a strategic move if they're structured right. So that about covers our topic today on owner loans. We do have one Q&A from following last week's episode on drop and swaps. So someone asked about a drop and swap, or a swap and drop, as opposed to drop and swap, which we talked about last week. So as the name suggests, it's very similar, just the reverse. So last week we talked about drop and swap, where real estate is dropped out of an LLC to the individual partners, and then some partners exchange and others cash out. Well, the reverse, a swap and drop, the LLC completes the exchange first, and then after a period of time will drop the real estate out to individual partners or cash some partners out. Very similar overall, just the reversed order. So that about does it for today. If you found value in this episode, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.